I'm Charlotte McLeod with the Investing News Network, and I'm here today with Simon Popple. Simon writes the Brookville Capital Intelligence Report, which is designed to help investors in the commodity space. This is part one of our two-part interview, and the focus will be on the system Simon uses to evaluate junior resource stocks. You can find the link to part two in the description below, and it will hone in on a case study of Chalice, a company where Simon used his system to great success. Without further ado, Simon, thank you so much for being here online with me today.
Great to be here. Thank you very much.
Yeah, great to have you here. And we're going to be speaking today about your system for analyzing junior resource companies and how investors can hopefully use that themselves. Before we get started, I just wondered if you could give me a brief overview of who you are and, of course, your background in the mining space.
Yeah, sure. I mean, my background really is investment banker, property, and commodities. So basically, what I used was a lot of the analytical skills from investment banking and property, and sort of moved those over into the commodity space, where I started investing probably about 12 years ago and did very well. So I was asked by Money Week, which is a sort of well-known publication here in the UK, to write a newsletter for them. And then when they got acquired, there's a guy called Jim Rickards who's quite well known in the US and perhaps Canada, and they asked me to write Gold Speculator. They also had a version of it in the US, and they asked me to write the sort of non-US version. So I did that for a few years, and then when Agora in the UK closed down, I wanted to have my own newsletter in the commodity space. So I set up the Brookville Capital Intelligence Report, and yeah, really enjoying it.
Great. Yeah, and definitely some well-known names in there that our audience should be familiar with. Now, as we get started, I want to talk about the 3 R's that you use when you make investment decisions. Can you explain what each of the R's stand for and the returns that you've seen using this process?
Yeah, sure. I mean, it's really basic, but I mean, the 3 R's are, first of all, resource. You know, people need to have actually got some money and some time to read the research that I put out. The amount of money they need varies, you know, from their own personal situation, what they want to do, but I sort of generally recommend people have at least $10,000 to invest, and then they can invest across a portfolio of, let's say, 8 stocks and keep some cash back just in case there's a market correction. So yeah, they need some money and time. It does, you know, it's only about 1,500 words, so it doesn't take up much time, perhaps, you know, 10-15 minutes, but they do need that to even start things off. So that's really what they're bringing to the party. The other R's are research. I research each opportunity using my bridge system, which stands for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. And the last R is about risk management, because every investor is different, and what is a good investment for one person may not be a good investment for someone else. So and at the outset, we try and find out a bit about what people want to do, what their appetite is for risk, and you know, try and work something around that, you know, that suits them and suits, you know, the kind of results they're looking for.
Okay, now you mentioned the R for research breaks down further into another acronym, which is bridge. And I want to delve a little bit deeper into that, working through it mostly in order. So starting with B for balance sheet, what are you looking for when it comes to balance sheet? Is there a specific amount of cash that you want to see there? How should it look when you're approaching a stock?
Yeah, well, I mean, that's a very good point. I mean, I'll get on to Chalice, you know, later on, but cash is important. I don't like debt if they're not generating cash. So if they're not a producer, I don't like it if there's debt on the balance sheet. And you really want a balance sheet that's sort of set up for the company. So if there's some cash, I like it ideally to be covering the next round of exploration. So you know, we don't get people involved and then suddenly, you know, they're going back to the market raising money at a discount. The whole idea is that they get some good exploration results and the share price then goes up. So if they are raising more money, ideally it's at a price that's at a premium to what I get people involved in. I think that's probably the main thing. Producers, I don't mind a bit of debt because they're kicking off cash. Debt can be a very effective way of having a good capital structure. But that's the main thing I look for on balance sheet, the sort of strength of it and the ability to be attractive to investors, I suppose.
Perfect. So if we're working through that bridge acronym, the next letter is R for resource, but I want to tie in exploration here as well. So we have resource referring to what a company already has in the ground. Exploration is all about future potential. What balance do you like to see between them? And do you always like to see some level of existing resource when you're approaching a company?
Ideally, yes. It's nice if they've already got a resource, even if it's not a formal 43101 JORC resource. If they've got something that they can kind of hang their hat on, that's nice. The location of the resource, and for that matter, the exploration potential is also very relevant because if they've got a good resource in Canada or Australia or the US, where I feel it's a safe jurisdiction to have a mining operation, then that's great. But if they've got a large resource or a lot of exploration potential in some other parts of the world, which I view as far more risky, some companies get their mines nationalized, and when that happens, essentially they're worth nothing. But you do need to be a little bit careful about getting too excited about a high grade or huge exploration potential if it's in a country where the asset is at risk if the government chooses to step in.
Right. And of course, infrastructure is also on the list. And I would imagine that ties into jurisdiction in some ways as well.
Yeah, completely. I mean, it's, again, people can get very excited if they see a really good grade and lots of exploration potential. But if there isn't any power or water or roads or rail to the site, the chances are that that mining company is going to have to build that. And first of all, that can be very expensive. And secondly, that can put off future funders, and people may think, well, I really like the resource, but, if I've got to spend 100 million building roads, power, and getting some water to it before I've even spent another 100 million on the mine, that can be a little bit scary for a funder. So I think that, you really want something ideally that is in a jurisdiction where there's an existing infrastructure. They may have to extend a power line or extend a road or something like that, but providing it's not going to cost them too much and be too off-putting to a funder, then it can still be very attractive.
For sure. And how important is diversity for you? Do you like to see companies that have assets spread across different geographies and commodities? And following on from that, where's the line between a company that has a good amount of diversity versus a company that may have spread itself a little bit too thin?
Yeah, that's a very good point. I mean, diversity is really on two levels. First level is the portfolio. You want to be investing in a wide range of not just different sort of mines, but different commodities and different jurisdictions. There's obviously FX. You've got exposure to Canadian dollar, Australian dollar, perhaps a US dollar. So you want to be diversified in a number of ways. I don't like people to be all in one commodity, so I like them to be across several commodities. I like them to be in different jurisdictions. Now, some companies are very diverse and they've got the money to take advantage of that. They've got enough cash to drill out their assets. But you can have companies which are, on the face of it, they look really diverse, but then you kind of look at their cash balance and they've got nowhere near enough money to explore those properties. And that can be a negative. You do have to sort of take a look at that and sort of say, well, yes, they're diverse, but is that a good or a bad thing? And I think that's one of the things the newsletter does, is it kind of helps smoke out some of those situations where someone may look at it and get excited, but closer inspection doesn't look quite so hot.
Right. And following on, we have G for grade, which is an interesting one as well. Grade can be a difficult one for investors to wrap their heads around, especially between different commodities, trying to understand what a good grade looks like. So what is your approach when you're looking at grade? And do you have any tips for people who want to contextualize it within a project and understand a little bit better what they're looking at?
Yeah, look, absolutely. I mean, grade is very important because you need to have some context to it. For example, in Nevada, you can get away with a really low grade oxide ore and make very good money. That ore is often at surface, doesn't cost much to extract it. But in other parts of the world, especially if power and water are difficult to get hold of, the grade could be much higher, but far less economic. So again, you don't want to get blindsided by a good grade. Don't get me wrong, good grade is good, but you need to look at what the recoverability is of the commodity from the ore. You need to look at where the grade is. If it's 2 miles down, it better be good, because the cost of extracting it can be very high. So again, good grade, generally good, grade, grade is very important, but don't get too excited until you've done a bit of research as to what's happening. And in particular, I think it's worth looking at their neighbours, because if they've got the same geology as their neighbours and they've got the same grade, chances are the costs won't be dramatically different from what their neighbours are pulling it out at. And if their assumptions are much lower, you may want to scratch your head and think, well, do I believe that?
Okay, so you've walked us through your bridge system for looking at junior resource stocks. Obviously, each of the points are important. That's why they're included there. But are there any that are more important than others? Or alternatively, are there instances where having a stronger rating on one point might make you feel more comfortable with a little bit of weakness elsewhere? How do you feel about that?
Yeah, very good question. I mean, I think they're all, I like to look at them all together. Where I can sometimes bend the rules is if I factor in management, because if you've got a management team that have got a really good track record in that region, then if they say we are confident that even though the infrastructure isn't in place, that we can deliver it, or I've got one at the moment, for example, I'm looking at. The infrastructure is not great, but the tenement is surrounded by Rio Tinto, and I was talking to the guy last week, and he said, look, if we get some decent exploration results here, Rio Tinto will be all over us. And so there's a kind of, and they've got lots of other assets where the infrastructure is great. So in those situations, you think, well, as long as they've got good infrastructure around some of their assets, that's cool. And the assets where the infrastructure isn't so good, they've got someone with very deep pockets, have already got a lot of land, and if they find something, then the chances are they'll get bought out.
Right. Yeah, I guess it is always about having that balance between everything. So you've taken us through this whole system that you use. Is there anything that we missed that you would want to highlight for investors who may want to start to use this approach to evaluating the companies that they're looking at?
Yeah, I think it's one of the main things about investing in this sector is the returns can be jaw-dropping. I mean, like Chalice, which I'll talk about later. I told people about it 15.5 cents, and it went to over $9. But what you need to do is not be too greedy. You want to have a good, diverse portfolio, and make sure that you will get some winners, you get some losers, but if you've got a diverse portfolio, you've got a much better chance of finding what you're looking for. So if you are looking to invest in the space, please have a diverse portfolio and don't stick all your eggs in one or two baskets.
Perfect. All right, so we will wrap up here for now, but for anybody who is out there watching, we will be going on to do a case study of Chalice, which is a company that Simon invested in. So thank you so much for being here right now. Once again, I am Charlotte McLeod with the Investing News Network, and this is Simon Popple.